Hello, everyone. This is a quick discussion on how to treat goodwill as an intangible asset. So this is covering the financial accounting and reporting subject under intangible assets. And this is not the advanced topic under a FAR subject. So goodwill, it's an intangible asset that is not specifically identifiable, has an indeterminate life, is inherent in a continuing business, and relates to the entity as a whole. So those are the following reasons in which a goodwill arises. But the only time that we will recognize goodwill in our financial statements is when it is purchased, if it arises as a result of purchasing a business. So the approach for goodwill is twofold. The first one is residual approach. Sa AFAR subject natin, ito yung majority na approach na ifa-follow natin, no? Tapos meron pa tayong non-controlling interest. But for financial accounting and reporting as an intangible asset, medyo straightforward lang siya. Na ang goodwill ay excess ng purchase price over the fair value of the net tangible and identifiable assets. So let's say na bumili tayo ng business, no? Ang worth ng business na yon ay 1 million. Tapos nagbayad tayo ng 1.2 million. In an ordinary scenario, we will consider the 200,000 peso difference as a loss, lugi natin. But that is not. No? We will instead recognize it as goodwill. Because in its literal sense, di ba? Pag sinabi nating goodwill, kaya tayo nagbayad ng 1.2 million pesos sa isang business na ang value lang ay 1 million is because we believe in the potential of that business. Kaya meron tayong excess na 200,000. No? Kaya naman pag goodwill, nire-recognize under residual approach kapag mas malaki yung binayad natin over the fair value of the net assets of the business that we acquired. While for direct approach, it's heavily formula-based, pwedeng purchase of average excess earnings, capitalization of average excess earnings, capitalization of average earnings, and present value method. I will explain this better later on after we have our illustration. By the way, you can download this file through the link that is pasted in the description below of this video. So, for illustration number 1, okay? So, si Brisbane, tinake over niya si Darwin, no? At ang binayad ni Brisbane ay 9 million. Tapos meron daw siyang assets and liabilities at fair value. Okay. So, sa books ni Brisbane, sa kanya na ngayon lahat yung assets at yung liabilities ni Darwin. So, sa books ni Brisbane, i-debit natin yung mga assets ni sa books ni Brisbane, i-debit natin yung mga assets and liabilities ni Darwin. So land, machinery, inventory, accounts receivable, and then accounts payable. And then we will credit cash kasi ito yung binayad natin kay Darwin worth 9 million. Okay? Let's actually have a formatting here. Here we go. So for land, that is 3.5. Machinery, 2 million. Inventory, 1.8. And accounts receivable, 700,000. Meron tayong accounts payable na 3 million. Okay. Other than that, meron pa daw tayong mga assets na trademark, 1 million. And patent, 500,000. So, how much would be the fair value of net assets of Darwin Company? That would be the total assets minus the liability. So that would be 6.5 million. Okay. And the purchase price is 9 million. Therefore, the goodwill to be recognized for this problem would be the difference of 2.5 million. So debit goodwill, 2.5 million. So pretty straightforward. Let's have another illustration. So what if si Java company naman purchased an entity for 6 million cash at the beginning of the current year? The carrying amount and fair value of the assets of the acquired entity on the date of acquisition are. So pag given yung carrying amount at given yung fair value, sa libro nung nag-purchase na company, we will record all of their assets at fair value. So that would be debit cash, debit accounts receivable, debit inventory, debit patent, debit property, plant, and equipment, credit accounts payable, and credit cash. So the accounts payable is 2 million, cash 50,000. Again, puro fair value po ito. Ayan. So the purchase price is 6 million less the fair value of net assets acquired, which is this one minus your liabilities. So kung ang binayad natin 6 million, meron tayong fair value na 3.3. The goodwill to be recognized is 2.7 million. And this will also balance out our entry. So that's the residual approach. Purchase price minus fair value of net assets acquired. Let's have another situation here in this problem. What if instead of 6 million, yung ating binayad na cash ay 2.5 lang? Okay? So situation number 2, yung cash na binayad natin, 2.5 lang instead na 6 million. So when we recompute, purchase price would now be just 2.5. The fair value of net assets acquired is 3.3. Meron na tayo ngayong negative goodwill. Ibig sabihin, ang binayad natin mas maliit kaysa dun sa value ng business na binili natin. Is that good or bad for us? Nagbayad tayo ng 2.5 to acquire a business that is worth 3.3 million. That's actually very good. So this is a gain on bargain purchase. Worth 800,000. So to balance out, 5.3, 5.3. So that covers the residual approach. For our direct approach, we have the 4 methods. So out of these 4 methods, yung tatlo dito involves the step of computing your average excess earnings, which is pare-parehas. Okay? So first is our average earnings, which is our earnings for 5 years divided by 5 years. So that would be 1 million, 1,250, 900, 11, and 1.5. 1 million, 1,250, 900, 1.1, and 1.5 divided by 5 years. Kung 3 years yung binigay, 3 years. No? Pag 4 years, 4 years divided by 4. Okay? For normal earnings, that would be net assets multiplied by the normal rate of return. So that would be 10 million times 10%, which is 1. So, kumbaga, ang ini-expect lang natin 1 million yung earnings niya. But in reality, nag-average siya ng 1,150,000. Kaya may excess tayong 150,000. So, in all of these 3 methods, parehas ito. Anong pinagkaiba? Notice here. Sa purchase of average excess earnings, we multiply it by the number of years. So, your goodwill under this method would be 750,000. For capitalization of average excess earnings, it would be divided by the capitalization rate of 8%. Careful ha, hindi 10%, 8%. And for present value method, it will be multiplied by the present value ordinary annuity. Ilang periods? 1, 2, 3, 4, 5. So 5. Anong rate? Ang rate na gagamitin natin ay yung ating normal rate of return, which is 10%. Ayan. So that would be 1.1 raised to negative 5. And then 1 minus the answer divided by 0.1. Divided by the rate. Ayan. So, ang ating goodwill ay 568,618.02. While for capitalization of average earnings, instead of getting the excess earnings, straightforward lang tayong average earnings, capitalization rate of 8%. So the net assets including goodwill would be 14,375,000. While the net assets excluding goodwill is 10 million. So kung ito yung net assets kasama ang goodwill at ito yung net assets na hindi kasama ang goodwill natin ay 4,375,000. So once again, to differentiate the four methods under, well, yung similarity ng first three ay pare-pareha silang average excess earnings. Ano pinakaiba? Sa purchase of average excess earnings multiplied by the number of years. Sa capitalization, divided by the capitalization rate. At sa present value method, multiplied by the PVOA factor. Andun naman sa name, capitalization, present value, PVOA. Ang pinagkaiba lang, once again, ay capitalization of average earnings. We divide it by the capitalization rate and deduct the net assets excluding goodwill. So that concludes our discussion. Please make sure to like this video, comment if you have any questions, and as well as suggest other topics that you want me to make videos for. So thank you everyone and hope to see you again. Bye-bye.